What's up, everybody? It's Monday, March 27th, 2023. Just wanted to cover a few things with you guys, some ideas that I have about the market overall, where we're going, what direction, what to look for, and some other things here and there. Then I want to end on some ideas I have, some conspiracy theories that are unproven. But anyway, yeah, and then finally I'll talk about some ideas for. Actually, I'll start with some long-term ideas for investing opportunities. If you guys are interested, where to get in, where to get out, that kind of thing. If anybody has Roth IRAs, I would suggest, if you can, start opening Roth IRAs for shares. And you can do options too, but for shares mostly. Tax-free trading. So you can apply everything that you learn here, make money, and keep all of it instead of just some of it. Let's start out with I've got a list here, but this is the ETF for robotics and artificial intelligence. It's an ETF like SPY. So, they, I don't know how many are in here. Probably like 50 or 100, I don't know. But anyway, as you can see, COVID crash, everything went up. We eventually peaked. We've been chopping around, and it started to crash November of 21. So all of 22 has been stuck in a bear market. Let me clean this up just a little bit. On my charts, you'll see lines. I'll talk about what these lines are. Actually, I'll just delete them and we'll start fresh. It's a little bit different than day trading. And you're also going to hear my fan spool up again because I'm still on this old computer. But a little bit different than trading. Investing is more about, buying, and you can average down and all that kind of stuff. Because time is not really against you with shares the way options are. So first, let's start out noticing some things here. This is the 50. This pink line is the 50 EMA. That changes as you go from week to month to, I have 3 month, which is quarterly candles. So when you're long-term investing, you want to look at quarterly, monthly, weekly as far as opportunities, and then daily, 4 hour and 1 hour for when to get in. So we'll start with the weekly. Monthly, really the only thing to know about is we had a large push forward, consolidated, came back down almost to the bottom, right? Here's the bottom. We're up a little bit higher. You could argue you have a higher low, but that's not really important. What is important is we now have moving averages. So we have the 50-month moving average, which is serving as resistance. You can see that we've come up to it and tested it a few times. Failed there, came up here and stopped, broke out and closed back below. Now we're testing it again, trying to close the month above it. That is the goal of banks and investors, is to go ahead and play these moving averages. If they can close above it, then that means it's bullish and it can continue higher, right? If it closes below it, we'll probably start testing this candle to see if this area is still support, and they'll come back down. So it's important, we've got a couple days left of the month, that they close above this line. Then we can start seeing a second leg higher, right? Their next target is going to be this candle around 34 area. They'll go after this candle, 40 area. And then ultimately you've got major overhead resistance in this area where it couldn't break through, right? 45 area. So 45 is ultimately a target for the bulls. So let's start talking about that. We've got a long ways to go from 30 to 45. Weekly, you can see this moving average. This is what got my attention. Is the weekly 50 was support. We broke it from COVID, but we all know what that did. So right here had some support, and the reason this is support is because that's when banks decide they'll use the 50-week moving average, and they'll also use the 200, which just started to show up because we've just now had 200 weeks of this being open. But the 50-week moving average is where investors like to get in and out. That's a large area of liquidity because all the banks know about it. So you have a lot of banks selling right here and a lot of banks buying right here. So it's easy for big institutions to get in and out. So as you see recently, the 50 is now support. We broke out, came down, tested it, and bounced. Came down here, broke it, but they bought it right back up. So now what we assume is that every time the 50 is down here, like right here, it got tested and pushed back up. Every time we get to the weekly 50, that's going to be a buying opportunity for long-term investing. And probably what I assume they're going to do, see how this is curling up already? They're going to break this wedge pattern, start to run up and test this 200, which is also a new high. So they'll probably do that, which will pull this up. And then every time we start to come back down, that's where banks are going to buy, right? That's just a short explanation of long-term investing. It's a little bit different than day trading, but mostly the same ideas, right? One thing you'll notice about this is very interesting is it gets climactic often. Like this one here started to curl over and then got climactic. We saw on the weekly chart the same thing. It got climactic. So there's a lot of interest in this area, area of robotics and artificial intelligence, more so than other stocks, because they're willing to buy it even when we are pulled away. Now ultimately those correct, but the idea is there is more interest in this than there is. Institutions would rather be in it than to wait for it to get to the 50, right? So that's a bullish sign. So yeah, all we're doing really is we're just chopping sideways in this bull flag pattern. We might come back down and test the 200 day. 200 day is also a very important area for large banks. As you can see, its resistance here is probably support. If you go back over here, I haven't looked at that, but as you can see, when you get to the 200 day moving average, that's where banks get in. This is where it started getting a little choppy because the 50 crossed over the 200 and they decided, this isn't gonna be sustainable. Let's go ahead and get back out. So they got back out, and you'll see there's a lot of chop around the 200 as well. A lot of indecision, a lot of buyers and sellers. So now that we're back down here, we do have some remaining sellers, but mostly it's going to be buyers. So what I'd like to see ultimately for long term is to see one more correction, and we can get in down here. IRBO is the ETF for long-term investing. At the same time, you want to look at what is inside IRBO, and I made a list I've shared before on Slack which ones I'm looking at. AI is actually, in my opinion, more bullish. As you see, we got real far away from the moving average, so we started to correct, and then out of nowhere, well, that was earnings. It wasn't out of nowhere, but out of earnings, they broke out of the wedge. They've already come back and retested it. So you've got, it was a great entry that I missed. You've got support, support, support. You've got the 50 right here. And you've got a back test of the trend line. So, I mean, the best entry is when you break out, retest it, and bounce. Because this is also support now, right? So that was the perfect day to get in, and we missed it. I wasn't paying attention. But if you guys use MACD at all, you can see we are starting to cross over into bullishness. Banks use this a little bit, but not really. Mostly the weekly, weekly and monthly. You can see when banks decided to start getting in and change the direction of the stock as the selling became weaker. This has acted as support. The RSI has. So we're definitely in bullish territory. Maybe a little bit of weakness here, but ultimately one more test of this and it'll go. This one as well, the 50 has been resistance. Now look at how big this stock used to be. This is where we first started trading it, back here on the daily chart. There was a wedge they were building here, but look at this price. It was $95. Got up double top here at like 175. Ultimately that's where it failed, but that's for another day. So you can see every time we got to the 50 day, they sold off, chopped around, broke it, but eventually sold off. Now he started to curl around, right? And we are in a bullish flag. Now we are above it. The 50 is going to be support. So as we continue higher, when it pulls back to the 50, that's going to be a good place to buy. So I like AI. Now, of course, if we see a move too fast, we might just break it and then get rejected. So that's like the end of the month here, first couple weeks of April. Depending on how fast we get up there, if we make a slow, nice, smooth thing to the middle of April and get a correction, then that'll be good. We could also just squeeze. There's a lot of short potential in this one because it was so high. So AI is one of my favorite stocks right now. DDD, I've gotten a little bit already, but same idea. It's already at the 200. 200 is support. This area 200 is support. Very, very good entry for long-term shares, because if you are to break the 200 and start closing below it a couple days in a row, then it's just going to fail, and you get out right here. Get out at 950 and let it fall. You don't have to keep buying it, and just get out. So let's make 950 our somewhere around here, 950. If you want to argue, this is actually support here, support here, support here, support here. So you could even make your stop tighter and just make it the 200. If we break the 200, 970, you could get out and see if it bounces, and then once we're back above the 200, get back in. But really I'm just waiting for this flag to break out. So the longer a flag is, the longer, like from here to here, the longer it is, the more steam it's building for a push higher. So, and we see major areas of resistance would be this top here, right? 1350, 17, 18 bucks, 1950. That's a little bit here, 22. So we could potentially move on earnings coming up, or just by breaking it, but we could move pretty fast if we could get over 13 to get climactic here to 17. So I really like DDD. That's also in the IRBO ETF. KC is another one. That's already taken off. So see here how we have a double bottom at the 200 and it just ripped because long-term investors are like, okay, that's my time to get in. And actually by bouncing before it, that's even more bullish. So this one, it can just continue to get climactic. I would probably be interested in buying it on a retest of this area, 550, 575 area. If we could somehow pull back and then go higher, because we have quite a while until we get to next resistance area. Let's be up here in the 16 area. So KC is interesting because from Kansas City. So MOMO. This one already had a move on earnings. Kind of just waiting on that to probably come back down, but ultimately getting over the 50 is a bullish sign for the next leg up. I will share the rest of these. If you've been around long enough, Dragonfly, that I was a big proponent of that one. It's been consolidating for over a year now. So we could see another move like this again. It ran from, now this was pre-split, so I don't remember what the price was, but basically $2 to $15, $16, within a matter of 2 or 3 weeks. So we could see another move like that. If you zoom in, we are back above the 50. So time to start loading up on DPRO, and if we ever had a drop down to 110, 120 area, something like that, you've got some support here. Dip below it and they bought it up, dip below it, they bought it up. It was resistance here, resistance, resistance. So I would say actually this is 115 area would be a really good spot. Come down like that and then just bolt higher. Let's keep an eye on that one. I'm not in yet. CMX. What is this one? CMX. That one's just, that's not it. That might not be a US stock. Let's skip that one. Anyway, there's a ton of them. If you're interested in this kind of stuff, Rockwell is big into automation. They've already been in a bull trend for since July of last year. And so if they were to get some kind of pullback back to here, that would be a good spot to retest the highs. ROK. That one you could use options. 275, get like some 300 calls for the end of the year and just see where it goes. Because ultimately, if you zoom out on this guy, it's in a pretty bullish thing. People like this one. Banks like it. Here. COVID dip, they bought that back up. They're buying all this back up. We're already back up here. So if we could get a pullback to the weekly 50, that would be the place to get in for a very large move higher. ROK. You'll be. It's interesting. I'm talking about these long-term investment ideas because I'm always bearish on the market, right? But ultimately, I could be wrong. So what we want to do is start getting in things small. Let's look at S&P from a long-term perspective. We could argue that it is still in a bullish trend. They bought it up here, bought it a little bit. We're flagging, you could argue. So if they break that and then this becomes support, we could get our crash. But we'll see, because here's what's happening. So that's a good transition into the S&P. let's look at SPX first, the actual S&P, and then we'll look at SPY for numbers. S&P has been in a downward whatever. We already know that. A few weeks ago, weekly chart. A few weeks ago, we broke out, came down. I was thinking that the break was going to send it, but we didn't. We bounced back up. So that's probably just an invalid trend line at this point. It would be interesting to see if we break that again, what happens. But basically what we're doing is we're just getting tighter. So making a wedge or whatever you want to call this, but they're getting tighter as things go, and eventually they're going to break out one way or the other. If they were to start printing again, the Federal Reserve, talk a lot about that. If they were to start printing again, then you can only expect that we would just continue higher, right? Your next resistance, if you were to draw lines here, your next resistance is 6,000 area. That would be a year from now, maybe December, but I doubt it. I mean, it's probably going to chop for a long time before we break out. But if they were to start printing again, then it's very possible that this was just a bull flag in a very bullish market, right? It's not impossible. I've got some theories that we'll cover, but yeah, that's for now. We also have to trade what we see and not what we think. So as far as where we are right now, if we get rid of this trend line and just use moving averages, because that's what the big banks are doing, we are, the 50 has been support. It wasn't even support. It was just there, right? Like we just kept chugging along, and then we finally broke it. Now it's starting to be resistance, but we got back above it. It's still resistance. We had the huge red day a couple weeks ago. We had some big red days last week. Every time we popped over the 50, we broke it. As you can see today, we closed below it. This is a day. No, that's a weekly. So as far as the weekly, we're still below the 50, which is a bearish thing. It would not surprise me to run another test of the 200 week, which was our major support here. So we could break down and then bounce. So that's why I'm leaning towards puts right now, because in the long run, we're still in a downtrend, and we don't want to be overly bullish. We don't want to buy breakouts. If we're under the 50, we want to try to catch the bottoms, because breakouts will fail. If you look at the daily, we have breakout failures in multiple places. This one here, I guess you could say really it's this one. 4008 was our number. Put a line back on the chart for you. But if you see, 4008 has been very important for a long time. Every time they get over it, they sell off. They got over it and sold off, over it and sold off. Came up to it, resistance, chopped around, broke it, thinking that it was going to become support, but then they broke back down. Popped up, sold off, popped up. Fed day, last Wednesday, they popped up, sold back off. So the expectation at this point is if we get up to the 4008 area, it's just going to sell off. So even if we close up big, we can have a reversal and close back below it. The daily, we did close above the daily right here. So this will be interesting tomorrow to see which direction they're going. But again, they're just getting tighter, and because they don't want anybody to be right. So, they're just they're just getting tighter and tighter. until eventually they decide where they're going to go, right? So nothing is certain at this point. We're literally in the middle of the market. I'm just going off of moving averages right now. The daily tells me that as long as we are above the daily, we can continue higher short term, right? So we closed above it here, so we could open up tomorrow and be up here and then chop around a few days and then break higher on Fed news or something. Or we can just gap over it if there's some kind of news overnight and then take off. Or that would have been our last attempt. And I grabbed some 388 puts because if they break back into this candle, you know, they're going to try to run a test of these lows again. 390 and try to break that, which is very possible because if you notice this, here's the kind of move that you expect. So we broke this. We had a pretty big candle right here, right? That's a seller at 4,000 selling. This one here, pretty big move down, right? This one here, pretty big move down. And if you'll notice, it's actually getting stronger. So you had some small sellers here, largest we've seen so far. This one might be a sign that they're lessening, but you've also got the 200 that might have just held it up. But my expectation would be, since it was getting stronger, you still have a very large move here. I would say if we can get back up here above this, we're going to get another pretty wicked candle down. And then if we break this area, you know, we can get our crash and retest some lows. I keep talking about a crash because if you zoom out to larger time frames, so let's do investor time frames here again. Let's start with the 3-month or the quarterly. So we've had a pretty strong move up during COVID, right? We have down here is the 2000. It looks like nothing now, but this was the 2000 dot-com bubble from here to here. This was the 2008 market crash, which broke the dot-com bubble lows and then turned around and ripped. And the reason it ripped is because of the Federal Reserve. So let's clean this up just a little bit. So these are 3-month or 1 quarter candles. If you look at this, for one, we have what you would call a blow off top, which is anybody that wanted to buy, bought, right? They got in, the major investors. You get to a point where you, like I was talking about being climactic, eventually you get to the point where you're so climactic you just can't go higher, and eventually you fail and you pull back to moving averages, right? But interestingly, if we're on a quarterly chart and we do a 4-quarter moving average, this pink line, in 2009, the Federal Reserve decided they were going to start buying the market, like literally buying stocks. That's why this was so bullish, because every time we got to the quarterly moving average, they would buy. So here we closed below it, so the Federal Reserve bought the market. We closed below the 4-quarter moving average, so the Federal Reserve bought it. Every time we got below it and closed below it, the Fed would step in and start printing. We closed below it in 2018, and they ripped it back up. COVID crash, the Fed was buying, and they increased their buying to prevent a crash. When they increased their buying, we got climactic, and so now we're in this pickle where we have inflation and all these other issues. They bought too much. They printed too much. They own $8 trillion worth of the market. And so when you're sitting up here thinking, okay, the Federal Reserve owns 1/4 of the entire stock market, you know, you could see a 25% crash if they just decided to sell. So we're at 4,000. That'd put us at 3,000. Right? to reset their books, and that's just the Fed. So think about everybody else who's invested, the other 75% of the people invested. But here's what's interesting. For the first time since 2008, when we closed below the 4-quarter moving average, the Fed didn't step in. Here you could argue that people bought, but here is pretty clear. We closed below it, and the Fed didn't step in. We actually closed lower. We closed below it. They pushed it back up, but the Fed didn't step in. So we ended up closing below the moving average. And guess what this month is? It's the end of this candle. If they can close above this line, then, which would be like right here, 39, basically let's just say 3,900. If they can close above 3,900, then we can continue pushing higher. And they're going to keep trying to test this candle, breakdown candle, and they're going to just keep pushing higher, right? We've broken the trend, and they can just keep pushing higher over the next few months, quarters. But if we come back down and close below 3,900 by the end of the month, which is, I don't know what day that is, Friday, which is not impossible to do, and from where we're at, if they were to turn this around and sell it back off, so we opened here, right? So this would be a long red wick and a red candle down here, whatever. We closed below this line, then that would be another bearish symbol that, that would be 4 consecutive quarters below the 4-quarter moving average. And that's a pretty big deal. So the Fed has a decision to make, and they'll probably make it on Wednesday. Are we going to start buying? They'll call it quantitative easing, or adding liquidity to the market. If they do that, then we can press higher. If they don't do that, it's very possible we close below 3,900 and the bottom falls out. And we see kind of a move like this, 60% retracement and then a dump. That's why I'm bearish, in my opinion, right now. And also just overall market conditions. If the Fed is not printing, then there's nothing holding the market up. So that's SPX. You could also make the pattern trader argument that we, broke out, but we didn't. We actually failed right there, which means this pattern is invalid, and so they can continue to break it and go lower. That we're just making a bear flag. I can't draw it all tonight. That we're just flagging here, and eventually we'll break down. The place to buy after the market crashes 6 months from now, you got COVID lows. You've also got support right here. Every time they get below this line, it's a good time to buy. They got below this line, it's a good time to buy. 2,500, 2,400 area, that would be the bottom of the market, which would also be about a 50% retrace from 4,800 to 2,400, would be a 50% pullback. Let's look at some previous crashes, and then we'll come back to this and compare them. Everybody was thinking the top was in a few months ago, because if you look at the daily 200, let's take this one off for a second, just look at the daily 200. We had the exact same pattern as 2008, where the 200 was support, got up here, and it came up and was resistance. And ultimately, in 2008, they crashed right there. So it's a little bit different because now we're back around it and we're testing it again. It's not really support yet. We've broken it again, so we'll see. But if you go back to the 2008 crash, as you see down here, right, you had support, came up, and it was rejected, and then we got our crash. And if you go to the 50 again, you can see they crashed to the 200. They came back to retest the 50 and couldn't even get above that, and ultimately they just waterfalled. So that would be an interesting place if we get there. We're not there yet though. Right now we're still chopping sideways. 2010 was a much smaller scale, but it's a very similar situation where we're in now. As you see, they were kind of making this bear pattern pullback. Everybody thought the top was in, we're going to crash again. But what they did was they chopped sideways for a while, and eventually they broke out of that, and they just continued higher. The 50 turned into support, and they just continued higher, right? So we'll see. So that's 2008. That's where, it looks interesting there. 2000 was very similar. It was a little bit weaker. It mainly just followed the 50 down. Then one that's really interesting to me though is the 80s. 1980s. It looks like nothing compared to where we are now. However, if you start zooming in, you'll see the exact same pattern, I think, that we're in right now. Let's imagine for a while here. This pattern should look very familiar to you. We had the COVID crash. This was the 80s, but what I mean is we had kind of a double top here, not double top, but like a trend line. They hit that. They had a crisis. They had a huge recovery. They chopped around for a long time, tried to break out, and ultimately failed, right? And it was long drawn out process. This was from, we're on a daily chart, but this was from March of 81 to August of 82. And really, you can even go back to 80, November, so almost 2 years of just bearish stuff. Junk trading right here. Junk for investors, junk for day traders. It was horrible. So anyway, but here's the interesting part. So you had the crash, huge recovery, which was kind of a curling pattern like this, and then you had your big bear market, and it was pretty much, it wasn't quite 100% retracement to the crash, but it was a good 90%, right? So it kind of looks like this. You had the COVID crash, huge recovery, and then bear market that lasted forever. And then out of that bear market had a huge return. Huge, right? Just monstrous. It was, forever. It just kept going. And then we had some more crashes here and there when it gets climactic. But ultimately, the pattern I'm looking at right now is crisis, recovery, bear market, and then the bottom comes in somewhere and we just take off. So let's compare the 80s to today. 1980 to our current market. We had the exact same pattern, right? We have a crisis, big curved recovery, bear market, junk, and ultimately my assumption if you were going to do a 90% retracement, or 90%, or even 100%, is that we will just keep going like this, and maybe not even that far, but just, whatever, down here. And from there, will actually be really solid support. And from there, just like the 80s, we'll have just a rip your face off rally for the next 2 decades. It will be SPY 10,000 by the end of the 2020s. That could be crazy. So that's why I'm looking for long-term investments, because if we're not even there yet and we're already starting to bounce, then we could be at SPY 5,000 by the end of the year. Interesting stuff. Last thing I want to cover is my new conspiracy theory that has to do with my lines. Where I get my lines, first of all, is mostly from 4-hour moving charts, or 4-hour charts, and it's tails, candle tails. Tail is like this. That's a tail. That's a tail. Because what it means is we got to that point right here. We came all the way down. That's from where we opened. Came all the way down, and they pushed it up above where we opened and went higher. It means there's more buyers down here than there are sellers, and likely all the sellers got out. But that's where I get my lines. 4-hour charts are the strongest. So you could say, let's look at this one right here. So we opened here, popped up, came all the way down. So right here, you assume every time they're going to get back to this number, they're going to sell back off, because the sellers are waiting at that line. Right? As you see here, yesterday, or Friday, whatever, they pushed it, they got up and pushed it down. Today they got up and pushed it down. Or no, this was today. This was all today. So, that would be a short entry there. Other lines, if you wanted to make support lines, you do the same thing. You find a tail, put a line there, see what it does. Right? So as you can see, that's where we stopped today. So that's a pretty significant tail. That means buyers stepped up right there. They came down there and buyers started to come back in. We'll see what happens. Now we're just in a chop fest until we decide which way to go. That's where my lines come from. So let's go over to SPY, and then I'll let you go here. I have this dotted line across my chart. 397 has been the kind of bull bear battle. 397, they fight around it a lot, and when they can stay above it, then they rip. When they get below it, they fail. They fight it, try to bounce, get below it, they fail, chop, get above it, they rip. So we're back here again, 397. That's where market makers are trying to decide, are we in a bear market, or are we finally getting out and going to be in a bull market? So pretty important. Just to note, April is typically a bullish month, so I wouldn't be surprised if we do go higher, especially because we have this bullish crossover on the MACD. If you guys use that, last time we did that here, we had a pretty solid move up. So if we do that here, we could get a pretty solid move up and retest these highs. 417 area. Something to watch there. But anyway, I've noticed this though. Here's my conspiracy theory. There are certain lines that are more important than others. And what that does is that dictates what the following day does. And this isn't 100% yet because I haven't figured out my lines. But I've noticed something that when there's a reversal, then you know that line is important, obviously, right? You had a big move up and then a reversal. A strong move like this should have been chopped and then kept going, and it didn't. It dropped way down. So there has to be something to these numbers, like this one here, 395.75. You'll notice that was important the other day. When we close above 395.75, the next candle is red. On this one here, now this is where it messes up, so I'm not sure exactly. There might be another rule, like if you close above 2 lines, then it invalidates it. But basically, and it doesn't tell you where it's going, it just tells you what the candle's going to do that day. So we closed above 395.75, so the next candle was red. I told you that one was, I'm not sure about yet, but for the most part, this looks like it's working. We closed above 395.75, so the candle was red. We closed above 395 or at 395.75, so the candle was red. I don't know. We'll see if that is true or not. But I'm going to start playing around with that. And same thing with green days. You start getting into some of these things. Like this area here, there's probably something here, 390, 391. We closed below 391.25. So the next day was green. So I don't know. I'm going to keep messing around with that idea. But part of my theory is that when they don't get to a number, it's because it frees them up the next day to do something different. So on this one, let's say this is an important number here, because we closed above this number and we had a big red day. We closed above this number and we had a big red day. So the assumption is they didn't want to close above 398.70 on a green day, because that would have caused a major sell-off. So by coming up short, and this is true, by coming up short of a number, it opens the door for a continuation move. So because they did not close above 398.70, the next day it opens them up to move higher. In the same way, if you drill down into these kinds of things, let me find an example here. There should be one within the last few days. Right here. So as you see, this pink line is resistance right here. So they got to that number and they sold off. They try to come up to this number and they sold off big time. So in this scenario, they got to this number in pre-market that day and they sold. They rejected it basically. But if you come up short of a number right here, they turned around before they could have just spiked that number, but instead they turned around first and then spiked it. And why that's important is, let's say you have a seller here. It's a true seller, not a short seller. He's sitting at this line, and he's got an order to sell, 1,000 shares or something like that, whatever, 100 shares, it doesn't matter. He's got an order to sell his shares right here. If you come up short and they start to move away, he might say, oh no, I missed the top, they're not going to get my number. So he starts to sell down here. Well, because he's out now, because he sold, then when they get back to that number, he's not sitting there anymore, because he changed his order to sell down here. So they can just push right above that number, because he's not there. There's no resistance anymore, right? So that's the importance of coming up short of a number. It means there's likely going to be a continuation. Works the same way on the downside. Right here today, they came into a number and they bounced away. So you have a buyer right here, and here's his or her mentality. If it comes back to 395.75, I'm going to buy some more. Well, it came down and bounced before they got to his number. So he said, oh crap, they're bouncing. I need to get in now. So he got in now. And when they come back down to this number, he's not going to be there anymore to buy the market, because he bought it up here, because he's chasing the market. So when they come back to 395.75 tomorrow, probably in pre-market, and open below 395.75, he's not going to get filled, and we're just going to slide right through it. Same thing happened up here. You could make the argument that you've got a seller right here. I think I might have already covered this. So clearly, sold there, sold there. So what did they do? They came up short, so that this guy had to chase. And he did. He dropped the market really good. But he chased it. He said, "Oh crap, they're moving away from me. I got to get out, because I'm not gonna get filled up here. So I'm gonna change my order down here." So what they can do tomorrow is open up here, and then, pre-market, push it up higher, and then when they get to 398.75, there's no seller there anymore, because he sold down here, right? So they can move higher. So bouncing before they get to a number usually means a continuation of whatever move that was. I'm sure you can find a million examples. If you want me to, just to kind of show you again, right here, you have a major seller at 393.15. This has been a big number for our entire year. 393.15 has been resistance over and over and over and over. So what did they do? They killed the market, like absolutely murdered it in pre-market before they got to this seller. So what did he do? He says, oh crap, it's crashing. I got to get out. Now these aren't short sellers. It could be short sellers, but these are mostly like long-term holders. So they wanted to get out up here when we retested it, but they didn't give him the chance. They left him at the altar, basically. So he's chasing. He's saying, oh crap, I got to get out. This is the crash. This is the crash. So what happened? They came back to 393.15. He's not there anymore. So they can push higher. So, important thing to know. Numbers are important. The reason numbers are important is it's not just charts. It's where banks and institutional sellers have their orders, right? There's a seller at 399.32, which happens to be SPY 4008 or S&P 4008. So every time they get there, he's selling from an institutional perspective. He gets to that number, his sell orders start to come in. Gets to that number, his sell orders start to come in. So we came up short of that. So it's possible that they just push through. If they run back up to it tomorrow and get rejected, then they know they're running tests. The whole market is just running tests to see where people are sitting. Right? That's the whole thing. That's all you have to worry about is what are they going to do next? It doesn't have to make sense. But if you think about all they're doing is just running tests to see if people are still in the market, then the market makes sense. So 397 was important. What did they do at the very end of the day? They ran a test of 397 to see if that seller is still there. If we open up down here tomorrow, pre-market opens down here, then that seller is still there. If we open above 397, then that opens the door to higher. Hopefully that was helpful. Spend some more time looking at robots and AI. I think that's really going to be important. AI is probably going to move like Tesla did in 2000, I would guess. You start putting volume on your charts, you'll realize things, um, you know, that plays a big part in what's going on. So you see there's large institutional buying here. You had a pretty big gap down on earnings right here, which tells me the institutional sellers, the people that wanted out, finally just sold. They just hit sell all. So now there's no more sellers and there's only buyers left. So we'll see. We'll see what happens, but I think AI is going to be a pretty big deal. Let me know if you guys got any questions. I would say sorry this is so long, but they're always this long, so I'm not sorry. Have a good night.